Welcome to Short View Trading. It's Monday, 4th of April, around 9 a.m. London time. And as always, we're going to talk to you about the outlook for equity markets on a 1 to 2 week basis, focusing on equity headline indices, key indices like the S&P500, the FTSE, the NASDAQ, the DAX, all those kind of key global equity indices. Where might they go over the next week or two? And what should you do as a trader, a swing trader? Should you be buying on weakness, selling on strength, averaging in, averaging out, and so on and so forth? That's the focus of these videos. They're free. Please do subscribe. They come out 2 or 3 times a week, Monday, Wednesday, Friday. Click on the subscribe button below and we'll make sure you get this content regularly on a regular basis. So let's dig in. What matters for markets this week? Well, it's a really big week for markets. It's been a very strong second half of March with that momentum topping out in the middle of last week. And of course, what we saw was markets starting to roll over in the second half, the back end of last week. Some real weakness on Thursday, a bit of sogginess on Friday, although a rally into the close, and that topping out on Wednesday, as I said. So after a very strong rally, the debate is really very much on. The bears are calling it a bear market rally. It was a short squeeze from the mid-March lows up until the middle of last week, whereas the bulls are saying, well, hold on, we're back in risk on mode. There's a resumption of risk on. The primary trend is now up. And added to that, the whole debate is confused and thrown up in the air by the inversion of the yield curve that we saw at the back end of last week, that the bears are jumping on as a reason to expect a recession anytime soon. Now, whilst I'm not negating the message of that inversion of that curve, the timing is more important. It takes a long time for that recession often to come through after the curve started to invert. So I wouldn't place too much emphasis on that. What's critical here is how the S&P holds in. Its price action over the course of this week will be very interesting. There's a ton of key support levels around here and not that far below where we are at the moment. The 61.8% Fibonacci retracement level on the S&P 500 was resistance until we blasted through it 5-10 trading sessions ago and moved above it. Now it's become support, and that 45.30 level is about where we are as we're recording this video this morning. That's a key a key support level at the moment. Below that, you then have the 200-day moving average of 44.79, so not that far away. Below that, you have the 50% retracement level and the 50-day moving average. So there's a lot of support around here, and the price action of the S&P 500 will be critical. Will it hold in? And will it hold in and then move higher? Is this just a pause in the resumption of the risk-on trade, which is typical as you move rapidly back into risk-on? You have a couple of good weeks, then you hold your breath in market terms and a bit of sogginess for a few days, then back into risk on. And interestingly, in that respect, 1 or 2 of our models got a quite interesting message. And what we've seen in a couple of them is fear quickly priced back in to market prices. Look at the put to call ratio, a big pickup in buying of put options in the last few trading sessions, which means investors and traders are quick to place hedges on in their portfolios because they're fearful, and they're quick to be fearful, which is often the way, as I said, as you're resuming a risk-on rally, the sentiment's still very bearish, people are very nervous, and therefore they're quick to put on those downside put protection. Equally, as well as that, you can look at our shortest term risk appetite gauge. This is a measure of fear and greed, and you can see it's very quickly moved back to fearful, which is a contrarian buy signal for a trader. So all of these signals are pretty interesting. We're going to be watching that price action very closely. We'll be writing about it all week in our daily rag. If you're interested in an update of our views going forwards, please take a free trial of the daily rag. Simply click on the link below and we'll send you the daily rag for free for 7 trading sessions. No credit card details required. Just give us your name and email address and we'll send that over to you, as I say, free of charge, 7 trading sessions. And in that, you'll get an update on our views, our recommendation on these equity markets, how we think you should trade it on a 1 to 2 week view, which equity index is attractive, what levels, and so on, and an update on all our 1 to 2 week trading models each and every day. So what are we watching this week other than the price action, of course, which is critical as just discussed. But over in the States, the Fed minutes coming out later this week will be watched closely, along with the ISM non-manufacturing index. That's always important. Over in Europe, Germany factory orders, ECB minutes as well, equally important as well. They'll be focused upon, and markets will be watching those, will be watching those. And then in China, you've got the services PMI coming out later on this week as well. So that's it from us. That's your morning market hit for Monday, 4th of April. Thank you for listening. Please do subscribe to these free videos on YouTube. Simply click on the subscribe button or follow us on LinkedIn, Twitter, and or Facebook. Thank you for listening. Stay safe. Trade well.